Good afternoon, everybody. My name is Bridget Posh. I will be the moderator for this panel today. We will be focusing on investing in emerging markets. I will start by giving a little bit of background of each of the panelists. Again, my name is Bridget Posh. I'm responsible for emerging markets, corporates at Babson Capital Management. Let me start on my right side with Ana Maria Carrasquilla. She is the chairman of the Fondo de Reserva Latinoamericano. Victor Chu, responsible and chairman of the First Eastern Investment Group. On my left side, starting with Bob Diamond, chairman and CEO of Atlas Merchant Group. We have Penny Foley, group managing director for TCW, and Jingdong Hua. He is vice president on the treasury and syndication at IFC. As you could notice, the panel is very well diverse in terms of several years of expertise in the financial sector, in emerging markets, from fixed income to private equity to equity, from Asia to Africa to Latin America. So our goal today is to discuss different aspects in emerging markets, different investment opportunities, different risks that come from the monetary side in the developed market, different political risks. But first, before we start, I would like to ask each of the panelists to actually replace the acronym of BRIC to something else. And that something else, link that something else, that new acronym, to their global perspective over the next 5, even to 10 years. Start with Bob.
A new BRIC. This is a little bit different than I was thinking when you first asked that question just then, but I would say it's Nigeria, Nigeria, Nigeria. I think the events of the last couple of weeks, I think we will look back and recognize that a peaceful, successful change of power in a democratic election, which is the first time it's happened in the history of Nigeria. And I don't think many people in the world 4 weeks, 8 weeks, 4 years, 8 years ahead of this could have anticipated this. This is in a backdrop of a country with 175 million people. And if I like to put things in perspective. If you look at the opportunity that Nigeria presents to the world, 175 million people, Bridget, and Brazil's just ahead of that. They'll pass Brazil sometime in the next 5 to 10 years as the 5th most populous country in the world. But if you ask the question, what's the market cap of banking in Brazil? It's about $300 billion. If you ask what's the market cap of banking in Nigeria, it's $12 to $13 billion. So the scale, if the largest GNP in Africa, sub-Saharan Africa, with the largest population, where there will be more children born this year in Nigeria than all of Western Europe, where there's rising discretionary income. If this is correct, the scale of the opportunity for Nigeria and the impact that that can have in sub-Saharan Africa, I think is singular in terms of the things that I certainly look at.
Perfect, thank you. Ana Maria, on your perspective.
Well, my perspective would be, of course, Latin America. And my new name would be PAC, Pacific Alliance countries. These are Mexico, Colombia, Peru, and Chile. They're a trade bloc that I think will be very interesting in the next couple of years as investment destinations. These 4 countries share a lot of common characteristics that I think will make them very attractive in the future. They have strong institutionalism in monetary and fiscal policy. We have our inflation and fiscal accounts under control. We have positive external liquidity ratios, economic openness, important role and involvement of the private sector in long-term infrastructure projects, and much better growth expectations than other countries in the region and in the world for the next couple of years. So I'm betting on these 4 countries in Latin America.
Very good. Jingdong, on your side, what would be your new acronym to replace BRIC?
Well, it's not too hard. So for me, what I would say, it would be EMMO. Emerging market means opportunities. Well, not a lot of people know this. The very term emerging market was coined by IFC in 1981. So just for those of you who don't know IFC, we are owned by 184 countries, United States being the largest shareholder. We have been doing investing, supporting private sector for more than half a century. So we have a lot of actual experiences investing, and therefore having experiences and also very, very aware of the risk-return profiles that we have been doing all over the world. So just to give you a sense of what we do, so in the fiscal year 2014, we invested about $22 billion in 600 projects in about 100 countries, in private equity, in debt, in mezzanine, structured finance, local currency, so on and so forth. So we'll extend the conversation later on, but what I need to tell you is that there is value to be obtained by investing in emerging markets. And you know, there are data points from IFC over half a century that would support that.
Thank you. Penny.
Well, I invest in emerging markets fixed income. That's a 62-country index, so it's pretty hard to come up with an acronym that's not quite a garbled and rather long one. I think the key to my space is that, you know, emerging markets fixed income is, you know, one of the highest yielding fixed income asset classes around. It's an investment grade index that's yielding about 5.5%. The structure of the emerging markets is fairly strong balance sheets, 40% debt to GDP, which is about half of what it is in the developed world. Growth is slowing, but it's still twice what it is in the developed world. Probably will account for about 70% of global growth in 2015. And emerging markets control about 80% of the world's reserves, which gives them the opportunity and the ability to pursue counter-cyclical policies in the event of a withdrawal of global liquidity. I think the key to our markets, and certainly in the last couple of years, is an increasing dispersion of returns. So some guys are doing the right things and doing well, and some folks are not. And I think a great example of that is the so-called Fragile Five, which was terminology that was introduced in mid-2013 when people began to panic around the potential for a tapering of QE in the U.S. And there were the Fragile Five were 5 countries that were deemed to be particularly vulnerable, high external deficits, large, high debt loads, high inflation, less credible central bank policy. So that was Brazil, India, Indonesia, Turkey, and South Africa. The reality is that there are 2 of those countries, India and Indonesia, really were facing huge deficits, both fiscal and external, and they started down a much better policy path. In both countries, you had governments elected that ran on reform policy, and both those countries have done extremely well from a performance perspective in the last couple of years. Brazil, on the other hand, had more options back in mid-2013, so they continued on to a heterodox policy path, and it was only when they were faced with a downgrade that they began to say, whoa, let's rethink this, and essentially the administration appointed a pretty credible financial team, and they've, given them the flexibility to pursue a more orthodox policy. Now, whether that works in Brazil, really the jury's still out, but they're at least headed in the right direction. South Africa and Turkey, on the other hand, really haven't faced their problems, and as a consequence, are much more vulnerable. So I think, the reality is the politicians don't make, the hard decisions until they've run out of every other option. And the key in my markets, or in our markets, is really to position yourself in front of those turning points to really produce alpha.
Thank you. Victor, you're the last one.
Well, in terms of dynamic leadership, scale, and still enjoying high growth, I will go for CHIM. which is China, India, Indonesia, and Mexico. They all have sophisticated policy leadership. They have scale, altogether about 3 billion consumers, and they're all enjoying relatively high growth in the foreseeable future. So, and also, it's easy to remember, CHIM.
Excellent. So, Penny, you gave us already a good global perspective about how you see different countries in emerging markets. Perhaps you could expand a little bit more in terms of how should we think about local currency versus hard currency. Relate a little bit more about the potential Fed rate hikes and what could that impact be to emerging markets, and even linked to the supply and demand we have seen.
Okay. In terms of dollar versus local currency bonds, we've been underweight local currency for the last couple of years, which has been the right trade. Local currency has underperformed dollar bonds in the EM space by about 20 percentage points over the course of the last 5 quarters. We like the rate story in the local markets. We're looking at yields about 500 basis points over treasuries. And the GBI, the GBI yields, that's the local currency interest rates relative to emerging markets dollar bond rates, are near, are over the long-term averages. The real headwind for us is dollar strength. And as we move toward normalization of Fed policy, we think that continues for a time. That said, local currencies have repriced by about 20% in the last couple of years, and rates have increased on local bonds from sort of the 5% range to about 6.5%. So we think, the local currency might be a very interesting opportunity. And if you look anecdotally at prior periods of Fed normalization, you've typically seen the peak of dollar strength at the front end of that normalization process. So it could well be that local currency becomes a very interesting opportunity for dollar-based investors, either later this year or early next year. In terms of interest rate policy, clearly it depends on the pace, and it depends on whether the market perceives the Fed to be behind the curve. If, in fact, the Fed moves on the back of improved growth in the developed world, that, in fact, could be EM credit positive, since emerging markets have the highest correlation to global growth. I think global liquidity stays at reasonable levels. You're looking, our base case is a pretty measured Fed move against continued monetary easing in both Europe and Japan. Today, about 53% of global bonds are yielding 1% or less. 20% have negative yields. It's really hard to see a huge ramp up in U.S. rates in that kind of environment unless inflation becomes a significant problem. If the Fed does surprise on the upside, I think the people who are going to be, or the countries that are going to be vulnerable, are those that have large current account deficits, have high inflation, and also have less credible central banks. The central banks in general in emerging markets have done a good job of increasing policy flexibility and credibility, reaction function in the last couple of decades. And so we think that with asymmetric monetary policy in the developed world, and the tailwinds of much lower commodity prices and very limited FX pass-through, that it's really only the weakest emerging markets that will be hurt seriously by rate increases in the U.S.
So now there's one thing that we have been hearing over, I would say, definitely over the last 6 months more and more, is about leverage in emerging markets. Mm-hmm. And specifically emerging market corporates, right. Total stock at 1.7 trillion. Do you see a credit bubble in emerging markets?
Mm-hmm. No, I think in the case of emerging markets corporates, it's a market that's grown substantially in the last 3 to 5 years. These are reasonable concerns to have. We think they're a little, that they're overblown for a number of reasons. One, a large amount of the new issuance has come from companies that are refinancing short-term bank debt with longer-term bonded debt. So in fact, what they've done is extended maturities and increased the liquidity of their balance sheet. Secondly, the mining and the oil and gas industry, which is about 20% of the SEMBI, actually has dollar revenues to offset dollar liabilities. So they're in a better position. In the case of the banks, which represent about 30% of the SEMBI, by regulation, they're often required to match FX assets and liabilities. I think that the area where companies are really at risk are domestic companies that have, local currency revenues and their dollar liabilities repriced substantially in a period of dollar strength. We think that's probably more of an idiosyncratic risk than a systemic risk. We expect the default rate in emerging markets corporates to be about 5.5% this year. But a large part of that increase comes from defaults of Ukrainian corporates, which clearly are challenged by the sovereign crisis in that country. If you exclude Ukraine from that calculus, we expect default rates to be about 3.5%, which is up only slightly from 3.3% last year.
Thank you. Yeah, Jingdong, do you agree with Penny? And what is your perspective when you think about IFC? And we know how much IFC has been involved in developing definitely the local debt capital market.
Well, look, I mean, I'll try to get 3-4 points out in 3-4 minutes. But I feel very strongly there is a sense of déjà vu. That is, just before Asian financial crisis, a lot of Asian companies, did this carry trade, borrowing dollar and generating revenue in local currency. And then we know what happened in 1997. Now I see a lot of Asian companies borrowing euro, right? So short term, given the nominally low interest rate, it's beneficial. And euro is also depreciating against Asian currency. But longer term, it's not a good financial management. So let me come back to IFC. On currency side, if 10 years ago, because we are a AAA issuer, right? When we issue, we tap about 10 years ago almost in dollars. Australian dollar, Japanese yen, but swapping into dollars. To a situation now, about half of our $15 billion annual bond issuance is in dollars. The rest is in local currency. And quite a big chunk of that local currency is not swapping back into dollar, but to finance projects in local currency, because we wanted to help our clients avoid foreign exchange volatility. So let me tell you a story very quickly. That is almost 2 years ago when Bernanke mentioned the word tapering. Indian rupee suffered some big volatility, as if you recall, there were some portfolio flows out. And so we worked with the Indian government and got an approval to become the first offshore Indian rupee issuer. And the success was even beyond our own estimation, meaning that in the last year and a half, we issued 99 billion Indian rupee. We call it masala bond, issued out of London Stock Exchange. And the demand is just overwhelming. Last week, it was our latest tranche where we plan to issue 10 billion rupee. We have to upsize to 16 billion because of the overwhelming demand from European American investors. And therefore, we were able to help set up a curve from 3, 5, 7, 10 year for the Indian government. And so 2 weeks ago, the Reserve Bank of India made a major policy decision for the first time to permit Indian corporates to tap offshore masala bond market, citing that IFC has proven there is demand from international investors. Because the truth is, right, obviously for IFC as a AAA, we issue a 6-7% coupon, although 100 to 200 basis points below government, but still as a AAA credit, if you have a belief in the long-term momentum of the Indian economy, it's a pretty decent pickup, even for US dollar investors.
So we heard about Penny talking about what she thinks about the leverage. You mentioned about the development of the local currency. You gave the example of India. Are we talking about more leverage in hard currency, in local currency? Are we in a bubble?
So let me just mention one more thing. Look, there may be bubble in terms of over-leveraging by corporate sector in certain countries. But overall, when you look at the infrastructure financing gap in the world, it's anywhere between $1 to $2 trillion. And when you talk to emerging market governments, that commitment to attract foreign investment, to attract private sector investment in build up that infrastructure, it's very strong. So there is business opportunity. On the other hand, as I said earlier, we have half a century of data to prove there is value. So let me just quickly mention this. We did a study of our own infra senior debt financing. Yeah, compare that with OECD. So here you have an IFC, globally diversified infra financing senior debt portfolio, and you have the OECD. What we found is quite interesting. Number one, the cash flow performance is very similar, is a double B plus sort of credit. Both are very similar. Number two, default probability and default performance is very similar. Both default probability, but recovery given default at 80 cents on the dollar. Very similar. What is the difference? OECD infra financing yields generally in LIBOR plus 200. Our dollar-based infra financing is LIBOR plus 400 with similar performance. And this is where there is value.
Thank you.
Yeah, I think on the sovereign side, if you look at where we were, a couple of decades ago when you had a real emerging markets crisis in the late 90s and where you are today, things are very, very different. The debt to GDP is 40%. That's down from about 100% back in the mid 90s, and it's not substantially higher than it was at the beginning before the global financial crisis. Significantly lower than the developed world. More importantly, and particularly in this environment of dollar strength, sovereigns have been borrowing significantly less, and they've been borrowing increasingly in their local markets. So they've reduced their, the volatility of their debt service to variations in hard currency. So probably, in the 1999 period, sovereign debt was close to 80%, 90% dollar denominated. Today, it's about 75% local currency denominated. So I think the sovereigns, and there are obviously exceptions to this rule, but the sovereigns as a group are in relatively good shape from a debt perspective. On the corporate side, again, I think it's idiosyncratic and not systemic. If you look at emerging markets corporates versus U.S. corporates, at every ratings category, you're getting paid a higher spread per turn of leverage than you are in U.S. corporates. So if you look at the BBB segment, U.S. versus EM, emerging markets corporates are offering about 2.5 times the spread per turn of leverage. In the BB space, it's about 1.5 times. So said another way, you're getting paid a significantly higher spread premium for similar level of risk.
Thank you, Penny. Now let me actually turn to Ana Maria. Ana Maria, your focus has been a lot in Latin America, and we know there's a lot of linkages with China. So when you look into Latin America, to some specific countries that is your area of focus, how do you think about the China slowdown? How do you think about commodity prices? And what are the risks and opportunities in this environment?
Correct. Indeed, the slowdown in China will have an effect in our Latin American countries, but I think that we should put that in a perspective. The estimate says that China will grow at least at a 6% pace. So this establishes a limit to the decrease of the terms of trade for our countries. Again, to give an optimistic view of our countries, Latin American countries are much more resilient than we were in the 80s and in the 90s. And we were very resilient in the last crisis. So I think that the slowdown in China is only one of the many obstacles we have. We also have the normalization of the U.S. monetary policy. we have the decrease in commodity prices. But again, I feel that the region as a whole, and in particular, the 4 countries I've mentioned before, Mexico, Colombia, Peru, and Chile, are more resilient and more capable of responding to these new challenges. And we haven't seen a very intense decrease in foreign direct investment either. So I think that we do have a lot of challenges, but I think that they're manageable in the medium term, 3 to 4 years. So that would be my point of view.
So you heard from Penny, and Penny mentioned about how emerging markets were 1 or 2 decades ago. You heard about her speaking and her views on the flexibility you have in the local currency in some of the countries. Within Latin America, in the countries you focus, how much flexibility, if any, you think those countries have when we do see a hike in rates?
Yes, I think that for one, there's a number of elements that are going to help us with this shock. We have floating exchange rates now in these 4 countries I mentioned, so that's one of the things that will help us navigate the new monetary environment of the U.S. We have more international reserves than ever, 400% more than we did in 2000. So we have an immense buffer to overcome a shock or a sudden stop or something that would happen if this monetary normalization in the U.S. is not done gradually. We have institutions like my own that can offer liquidity in very fast and timely manner to our countries and our central banks if they have a liquidity problem. So overall, I think that we're better prepared to deal with the shocks, if any.
Thank you, Ana Maria. So Victor, you heard Ana Maria speaking a little bit about the China slowdown, and she does not believe that that is the only reason that could create volatility for some of the Latin America countries. You have been involved in China, one of the pioneers on the equity side for Chinese equity. When you think about China's slowdown, when you think about where commodity prices are today, mainly on the metal side, do you agree? I mean, I know you have not been investing in Latin America, but do you think the way the market is thinking about the China slowdown and the commodity prices and the supply is correct?
I think so. I agree with my learned friend here. I think the so-called slowdown is really a more sustainable evolution. It will make us all more resilient in the long term, and I think that will be good for the economies all around.
Okay, so now let me switch a little bit of the China slowdown, and would like, and I'm sure the audience would love to hear your opinion on when you do your investments on the equity side. There's one thing that always comes up, not only in China, but recently more and more in China, about the political risk element, about the anti-corruption that we have seen investigations over the last few months. How do you quantify that in your investments? Can you?
Well, in a very strange way, the anti-corruption campaign, which has been going on, actually improves the political risks in the long term. Because as many of us know, corruption in the grand scale that China have been subjecting to, pose a real risk to the very legitimacy of the party and therefore the regime. And it wasn't sustainable. Something needs to be done. And although it has raised a lot of confusion and distraction and in some cases dislocation, but it does enjoy the support of the man on the street. So I think in the long term, it's good for the country. As an investor, I'm more comfortable that it's being done, seriously and hopefully effectively. I think now the question as to whether the anti-corruption campaign is at the beginning of the end or the end of the beginning, I think the answer is quite clear. It is only the end of the beginning. It will go on for some time. That shows that this leadership has the political will to see it through. Or put it another way, they see the risk of not going through with cleaning up is greater than going all the way. Right? So I think from that point of view, I would submit that in terms of political risk, China is gaining ground. In terms of the dislocation, yes, I think right now, in some cases, departments are not making decisions as efficiently as they used to be. But that is a transitional period that those of us investing in China in the last 30 years, we're used to that. Every 10 years or so, you have that kind of a transition. It's just this time, the transition will take longer. And also, the leadership is taking on a major effort in advancing rule of law. For those of us who sitting here, we might laugh about it, but when the new president came into power, one of the first major decision is to get rid of labor camps. And there is a very, very dedicated effort to make sure that the court system, the training of judges are being dealt with. And they've just introduced a system that we know quite well here, the circuit judges. That means when a case is tried in Qingdao, you don't have the local government influencing the judicial independence. A judge will come from other parts of the country to deal with it. So these are low-hanging fruits that they're tackling. And it is painful, but I think needs to be done. And long-term, I think, for the investment world, is positive.
Now, how do you think about the Chinese equity rally? Is that sustainable?
No. I think I agree with Penny. I think the question is whether this recent rally is a one-off or can it be sustainable for some time? And I think the answer is somewhere in the middle. We have to remember that until recently, the Chinese IPO market was frozen for a couple of years. So there's a bit of catching up because there's huge domestic liquidity. Secondly, we have this Hong Kong-Shanghai Direct. Investment institutions in China has recently been allowed by the Chinese government to invest up to 10% of their assets internationally. And because that coincides with the introduction of the Hong Kong-Shanghai Direct, that means 300 odd stocks on the Hong Kong market and with the equivalent similar number in Shanghai are now mutually can be traded. So that is the first stop that these investment institutions will go to. But long term, it can't go up 10% every day. So I think now, as I have experienced 3 times in my life so far, when taxi drivers and domestic helpers are beginning to play the market, now is the time to get out.
Yep.
Thank you, Victor. Now, Victor, I will need your help. We're going to have to transition from China to Africa. Some of you might be thinking, how do we make that transition? Let's make the transition by asking a question. How do you think the impact in terms of China growth could be with China to a certain extent? One of the plans of the Chinese government has been exporting that spare manufacturing capacity. And some of the countries that have been benefiting from this spare capacity has been Africa. So when you think about China, and then I will turn to Bob to speak about Africa, how do you see that impact? Do you see that as a change in terms of adding to potential growth?
The Chinese leadership has a buzzword, and that's win-win. They're not just exporting manufacturing capacity. They expect exporting technical expertise, capital, and also some of their newfound financial and capital markets techniques, because they're slightly ahead of the curve than some of the frontier economies. So there are, for example, the Chinese high-speed rail has enjoyed great success within domestic China. Now they're exporting that to the frontier economies near China and hopefully into some of our African brother countries. In fact, they're trying to bid for Los Angeles even. But I think in those cases, obviously, one has to look at whether the quality, the pricing, and the transparency can benchmark to the scrutiny of international standards. If they can, then I think there's nothing to fear, because it's not really exporting the spare manufacturing capacity per se. It comes with capital, goodwill, as well as technical expertise. So from that package point of view, I think it's win-win.
Okay. And let me actually move to Bob. Bob, do you agree with Victor? Do you think that is helping Africa? And then how do you link that to the Western world in investing in Africa and that competition between China and the Western world?
It's a great series of questions. By and large, I think Victor is absolutely correct. I think this can be a win-win. I think there's been some early back and forth about, is this about resources or not about resources? And I will say today, for Africa, one of the most important developments in the last 10 or 15 years has been the significant investment from China. Infrastructure, roads, buildings, it's had a major impact. And the investment from the US and from kind of the big financial centers of New York and London pale in comparison to that direct north-south China-Africa opportunity. Now, from China's point of view, I also think it's been, particularly in financial services, it's been pretty thoughtful. China has not, gone down there and tried to buy up a lot of banks. They haven't been building bricks and mortar. If I were advising them on how to begin doing banking business in Africa, the first thing I'd say would be follow your customer. You know your customers, you have deep understanding of them, so it's going to be less risk for you to expand outside of China into Africa if you're following your customers. From an African point of view, that does create some issues, and it's not a China issue, it's really an African issue. So, financial services being robust is so critical to the next 10, 15, 20 years in sub-Saharan Africa. And most of the business models are very simple. They're deposit-taking institutions that buy treasury bills. And if you're buying a treasury bill in Botswana that yields 12 or 13 or 14%, you have absolutely no incentive to be lending to consumers or lending to small businesses. So we have all the trade finance of the European banks pulling out with Basel III. We have the big global banks doing business with the big global companies, but afraid to get down on the ground. We have the South Africans who have been frozen for the last few years with higher NPLs, weaker currency, issues at home, if you can say it that way. And the Chinese are coming, but they're primarily following the Chinese companies. So the way I would say it, it's been a huge success for China in Africa, but it's not sufficient. It's not enough, and that's not a knock on anything. It means that what we have to do is we have to create domestic lending to African businesses and to African consumers. If Africa rising and the wonderful future that we all know is going to continue, we have to get lending into the economy. So I think you said it very well, Victor, and I think the relationship between China and many of these countries is really, really strong.
So taking the point that you mentioned, you need to create that lending in the domestic market to those domestic companies. And we heard Jingdong mention about the amount of money that was issued in local currency. How do you translate to the financial service? How do you make those, and you mentioned about the sizes and you compared Nigeria to Brazil. How do you make those financial services to start lending in the domestic market, in and not thinking about investing that money in sovereign debt that is yielding X%?
So it has to be both the domestic governments and private enterprise working together. So there's no incentive to lend because of the high T-bills. So what Central Bank Governor Sanusi, before he was unceremoniously ousted, was doing in Nigeria was he was consciously lifting the capital charge to hold domestic T-bills, giving the banks a lower rate, forcing lending into the economy. The African Development Bank, we're working with them on giving credit guarantees. The subtlety to the decision Monday, the announcement Monday that we acquired a second bank in Rwanda, 45% of the shares in the bank that we acquired Monday in Rwanda were owned by Rabobank. They want a lower percentage of the bank, but they want to work with us to develop the agricultural sector. And that's the key, getting banks like Atlas Mara, Rabobank, banks on the ground in Africa who develop really, really specialized lending units. So if we can focus just on agriculture and really get to know the industry, really get to know the people in it, then you're going to see less kind of credit risk, if you will. And you know, part of our business plan is to be incredibly positively disruptive. And when you're really disruptive to get lending to small businesses and you're in line with public policy, then it's like pushing on an open door. Now, why does this make sense for us as a private company? Well, it's nice to both do well and do good, but it has to be more than that. And our view is very, very simple, that if ultimately we believe in the promise of Africa and the promise of Africa rising, then T-bill rates are not going to be 12 or 13 or 14%. They're going to be more normalized. And we need to get ahead of the curve and create lending platforms to small businesses and to consumers. And it's a huge void right now.
So now, when you think about investing, those investments you have made, how do you explain or how do you get your investors comfortable in the same question that I asked Victor on China, in Africa, the political risk element, the rule of law?
It's a great question, and actually, I think you asked it this way. It relates to who's investing. So, first of all, we're not investing in every single country in sub-Saharan Africa. Our target is 10 to 15 countries, and in each of those, we have to believe that the risks that you identify are manageable and are priced, so that we're getting paid for that in our investment. The second thing is the business model. We only take majority positions. We're operators. And so anyone who invests in Atlas Mara knows a couple of things. We have permanent equity. We're listed on the London Stock Exchange, which immediately says we have the imprimatur of governance and all the things that go along with a London listing. But also, we only take majority positions, so we have the levers. And I think we were very surprised on our IPO. Anyone that's raised money for Africa knows how difficult it is to get US investors to actually do more than talk, but invest in Africa. And in our IPO, 90% of our investors were from the US, and the vast majority of those, it was their first investment in Africa. Why? Because of the listing on the LSE, because we're taking majority positions so that they knew that we had the control to be able to manage the businesses. And I think that makes a very, very big difference. But we're in the very, very early days, Bridget, in my mind, of encouraging more investment from more areas of the world in Africa. Everyone's interested. And I think people are beginning to look at it more, but we're in the very early days of getting people to seriously invest there.
Now, one of the things we have seen in other regions, Latin America, for instance, is the development or the changes on the regulatory aspect on financial services, in which you might see more competition coming in when at a stage when you're seeing more development. How do you factor that in when you think about a long-term investment?
Well, I think it's great for us because I think that as investors or operators, however you term it, we will benefit from more competition. And so there is so little competition right now in Africa that it's actually not healthy. So to the extent that we are imitated, it would be great. It's good for us selfishly, but it's also good for the market, and it needs more participants in the market. But we also have to do a better job of marketing this. I mean, there's such, I feel as an American, I can say, you know, I benefited from living in London for many years with our family because we're in the same time zone and we're in Africa a lot, but it's not very close for Americans. So I think the perception of Africa is at least 5 to 10 years behind the reality on the ground. I was on a working group this morning where Mimi from OPIC, which is the lending institution in Washington, said, of all the portfolios that OPIC has lent to Latin America, around the world, the one that has had the highest return is Africa, sub-Saharan Africa. And they haven't had losses, and they haven't had graft. And so I do think that, of course, we have to worry about political risk, and of course, we have to worry about a lot of those other issues. But focusing on the right countries and pricing that risk correctly, the history of most investors has been a lot more positive in Africa than one would gather if you kind of listen to the popular stories.
So Penny, now from the fixed income perspective, we have seen the last probably 18 to 24 months more African countries on the sovereign side coming to the market. On the corporate side, you know, probably not as much, but some utility companies, some banks, definitely out of Nigeria, but not as much. How do you see that evolving? And from a fixed income perspective, where do you see the opportunities in Africa?
You know, I think Africa's become really more of you know, it's no longer a niche market for fixed income investors. It's really a part of a diversified portfolio. It represents about 10% of the MB. It's about 30% of the next gem, which is sort of the frontier market segment of the MB. And, you know, it's been one of the fastest growing areas in our markets over the course of the last 3 to 5 years. And people, you know, there are a number of reasons for that. It's the transition to a more democratic, you know, government system. There's peace dividends in a number of countries like, you know, the Ivory Coast and Angola. There are, you know, a number of countries that have now done pretty smooth transitions of power. Nigeria was a great surprise that it was as calm as, in fact, it turned out to be. So, you know, we're at this point, you know, and the other thing about Africa is it's the one area, a large area of the world that still has a huge demographic dividend. You know, you don't have that in China any longer, but you've got huge growth in the labor force in Africa. We have currently, on the dollar side, we think a lot of sovereigns are pretty tightly priced, so we're underweight on the dollar side. Local currency, we clearly like the rate story. On the currency side, you know, some of these markets are sometimes like the Hotel California. You know, you can check out, but you can never get to leave. So you have to pick your spots pretty carefully in those markets. If you have a portfolio that requires daily liquidity as opposed to you know, an investment, longer-term investment horizon. But we think Africa is a very interesting area and continues to grow as a part of, you know, the fixed income opportunity set.
Thank you. So, Jingdong, we spoke about the local currency. You spoke earlier about the development of India. Now, when you think about Africa, I mean, I think one of the things, and I'm generalizing because each country is a little bit different, but it has, if you think about that, it's much more hard currency. Some countries more linked to oil. How do you think about, as IFC, developing the local currency debt capital markets?
So,
because I think, that will have a direct link as well to the financial services.
No, look, I'm passionate about Africa. When I lived in Africa 20 years ago, almost all the sub-regions of Africa were either in civil or regional conflict. And now we have the peace dividend. You know, the unfortunate terrorist activities aside. So most governments really are realizing the economic growth, providing jobs, building the economy is their mandate. So it's really now very, very gratifying to see Bob and other private sector investors coming in. By our mandate, we cannot pick and choose countries. We actually virtually invest in all the countries. And so what IFC does is sort of one step, including African Bank, is one step ahead of you in the sense of identifying policy gaps, identify the building blocks so the government regulatory framework is much more friendly to the private sector, and you have the human capacity to process those investment proposals. And a big topic is developing capital market. Look, let me digress a little bit. That is, governments realize ultimately they need to denominate most of their economy in their local currency, okay? Especially big economies. And this is both opportunity and challenge for institutional investors, provided there is a hedging market, going on once capital market is developed. In sub-Saharan Africa, this is one area it is really falling, way behind the other regions. So let me say that apart from South Africa, when you look at the corporate debt as percentage of GDP, right? You look at the United States, it's over 100% of GDP. In Asia, is 25% of GDP, from Malaysia, from Thailand or China, Philippines, all the way to 70% of GDP in the case of Korea. And Latin America has very well developed capital market, maybe sometimes a little too developed. But in sub-Saharan Africa, apart from South Africa, the corporate debt as a percentage of GDP is in low single digit, right? So it's really, really a big issue. And it will take some time for us to do. For example, when we started to engage with Nigerian government to issue IC first Naira bond, it took us about 4 years, right? Because putting a AAA name on the domestic regulatory framework, we have to make sure things are ready, including working with the SEC, working with the pension commission so that they can expand the regulatory framework to allow the pension insurance company to come in and invest in corporate debt. So, things are progressing. By the way, there was a recent corporate issue out of Nigeria called Seven Energy. Bob, you probably have heard it. It's an oil gas company that tapped into euro-dollar market. So we have started to see things coming out, but it's a long process. Another thing I very much agree with Bob, that Africa continent is 54 countries, right? Its investment is in the details. One country is very different than the other. So I think for US-based investors, educating ourselves is critical, right? In the sense that when an Eastern Africa leader comes to the US, being interviewed, the first question is Ebola, which is thousands of miles away in West Africa, right? That's really, the foundation courses 101 that we need to understand. Clearly, there are African countries, Rwanda being a primary example, where the government has been determined to improve their regulatory work, learning from Singapore, learning from other countries. They have done a fantastic job. They're great success stories. So it's a medium to long-term goal, but hey, a country like, you mentioned Nigeria, DRC, a country with trillions of dollars mineral wealth and hydro wealth, 80 million people, total bank capitalization of the 30 banks is only $3 billion, right? So it's, when you look the other way, it's huge opportunity for Bob, for IC, for a lot of other people. So I remain very bullish about Africa, 1 billion people with a bulging middle class. In the case of Nigeria, MRI machines in the single digit. Just imagine, the number of MRI machines that they need to set up to improve public health. Tremendous opportunities.
Thank you. So let me take the local currency and move to Latin America. Ana Maria, I think you spoke a little bit earlier about the different countries in Latin America. Now, when we think about Venezuela, and we hear about the development of the local currency, how do you think about Venezuela with almost a non-existent local debt capital markets and most of the debt in hard currency with, probably today, fair to say, with a market which is they're locked out? How do you think about countries like that, and how do you think about your investment?
Venezuela is a member country of FLAR, first of all, and so Venezuela is very close to our heart. We think that this is not the only problem Venezuela faces today, not having a developed capital market internally. We think that Venezuela faces much larger obstacles right now. As FLAR, we are in the business of helping them and trying to do our best to be there if they need us. We're not sure if Venezuela is going to default or not. It's difficult to know the exact situation because we don't have the numbers. The government doesn't give the numbers, so we don't know how bad it is. But as a general statement, FLAR is here to help Venezuela. And that's all I'm going to say about that.
Thank you. No, thank you. Thanks for sharing. We have a few minutes before we finish our panel. I would like to open up for questions, and I think there's one here. I don't know if we have a microphone. So we.
There is one.
Thank you. A great presentation. So I was wondering if you can elaborate on the MILA, the integration of the Latin America stock exchanges, as well as the Southeast Asia consolidation of the stock markets. And how successful is that? Is that going well?
So perhaps we start with Ana Maria and then Jingdong, if that's okay.
Yes, it was MILA. For those who do not know, it's the integration of the four stock exchanges, Mexico, Colombia, Peru, and Chile. It's one of the biggest stock exchanges in the region. There has been challenges in putting together all the pieces so MILA works perfectly smoothly. It doesn't yet. We hope it will soon, but we think it's a very, very ambitious project, and even other exchanges thinking about joining MILA. So I think it's an overall very, very interesting project that is in the progress. As I say, it's not working perfectly yet, but we're getting there.
Yeah, when it comes to Southeast Asia, I think after Asian financial crisis, the regional bond market development has been going on, and I think achieved a pretty good results. When it comes to stock market, I think it's more for dual listing, triple listing, rather than consolidating into a single market, because there are national champion companies where probably the country want to retain in that. Exactly what happened between Rwanda Stock Exchange and Nairobi Stock Exchange. They have several, stocks now. They cross-listing, so I think that probably is a way to go. But when it comes to debt market, it is also about how do you have a regional standard, so that citizens from Korea can, easily buy a bond issued out of Malaysia, and be able to settle and clear without friction. So I think still work in progress, but I think it's getting there.
Thank you. I think there were a few more questions on this side.
Hi, this is Tim Matson. This question I think is for Penelope. What's your opinion about investing in Chinese local fixed income markets via an RQFI structure? And then just as a follow-up, how long do you think it will be before the currency, the renminbi, is fully convertible?
I think in terms of the fixed income markets, we have not registered to invest locally. We do, there's not much in the way of government bonds that are really attractive relative to the global opportunity set. We have invested both in dollar-denominated bonds issued by corporates, and that's largely been some of the banks, a lot of the property companies, and some of the industrial companies, and then in the dim sum market as well, which is renminbi bonds issued by corporates offshore. And that's been a very attractive market. Obviously, with the change in policy with regard to the property sector, that segment has slowed substantially in terms of growth and relative attractiveness. But we continue to be very much involved. I think you're probably a better one to respond to the internationalization of the renminbi, but I suspect that's a goal, and I suspect, like all things Chinese, it will be sega, slowly, slowly.
We have time for one more question.
Thank you. I think this is a question probably more for Victor and Jingdong. So I just want to follow up on the credit market in China because I'm a consultant and we have client money over $1 billion actually invested in the country. So one thing that strikes me is that the rules in terms of the regulatory regulations of government is sometimes unclear, and I've found that in certain areas of the market where there is for example, promise of no loss of principal, which to me is something that absolutely cannot get guaranteed, but it gets done anyway. And those who do not offer that type of guarantee will not be able to do the business. But and when I look back in 2008, we have the financial crisis, but it probably started from the credit market meltdown. So how concerned you are in terms of this type of phenomena? Is this something set up to blow up at some point and and kind of jeopardize the economy for the country? Thank you.
And sorry, Jingdong, I ask you if you can answer this question in 30 seconds.
Yeah. So when I left China 25 years ago, nobody knows what a bond is. So I think in the last 25 years, China's bond market from nothing to about $6 trillion. It's a big development. I think it's still early stages. China needs to develop a credit culture. That is, an investor really have to look beyond the headline ratings and look at the balance sheet. That is a process that is still ongoing. But I think the central bank and regulators recognize that. And indeed, the World Bank Group have been partnering with the central bank regulators in terms of improving those regulatory frameworks to protect investors. So I remain very optimistic, but it will take a bit of a while, including investors themselves doing a better job discerning, credit differences.
Yeah. I think, in terms of the reform process that the Chinese government is going through, I think the elimination or at least the reduction in moral hazard in the market is really a key element of that. And so you'll see, I think, increasing allowance of companies to go bankrupt, to really take away the notion that whatever it is, you got a government put. I mean, and that, in our view, is really credit positive for the market and the long-term development of the market.
Well, thank you so much. Thanks the audience. Thanks the panelists. Thank you.
Thank you.
Thank you.
Thank you. Thank you.